Welcome to Yahoo Finance Live and happy Friday. I'm Julie Hyman. That's Josh Lipton. We're here at the New York Stock Exchange with Big Three at 3, the top 3 stories to watch as of 3 p.m. Signs of progress in the United Auto Workers strike. The union securing a big victory from General Motors. UAW President Shawn Fain announcing that GM will treat workers at EV battery plants just like workers in engine and transmission plants. And as a result, there are no new strikes being added this week.
And a red-hot September jobs report, hiring surging last month, employers adding 336,000 jobs. That is nearly double what the street was expecting and up from 227,000 new jobs in August. The odds of a rate hike in November moving up about 10% in response to that report.
And we are seeing a big market reversal on the back of that report. Stocks climbing from early declines, now trading higher than 1% across the board. And taking a look at the bond market as well, yields also rose initially to 16-year highs, the 10-year going up to 4.89%. But now we are seeing a moderation in that move. Let's take a look at the equity market right now and take a check on what we're seeing now, because we have seen really very divergent reactions following that jobs report this morning. Initially, as we mentioned, stocks fell, Treasury yields rose, but now we've seen a big turnaround here, and stocks are trading at the highs of the session. The Dow up now by nearly 400 points, 1.2%. The S&P up about 60. That's good for a gain of 1.4%, and the Nasdaq gaining 1.7%. As you might surmise from what we're seeing there, it is tech that is leading gains in the market today. And let's take a look at those treasuries as well. Again, here seeing a big change from what we saw earlier in the session. Earlier seeing gains of as much as something like 17 basis points in the 10-year yield. But now we are not seeing moves like that.
Nope. Let's dig into that September jobs report, Julie Hyman, because the market action was interesting today. That initially we get the report, right, and it's blistering. It crushes the expectations. I mean, the forecasts were way off, which is in and of itself interesting. I don't know if it's just getting harder for economists to kind of predict this labor market right now, but they're way off. Comes in hot, and the market reacts the way you would think. Yields pop, stocks drop. But then, as we begin to sift through the report, people thinking, all right, the headline was really hot. Unemployment holds at 3.8%, but average hourly earnings rose 4.2% from a year earlier, and that was a tick down from August. Right. So maybe that gave some investors comfort, or who knows, it could be just technicals and we were just really oversold. Either way, you got a big bounce right here.
Right. Do you get the sort of quote unquote immaculate disinflation scenario where you still have robust job market, but you have inflation coming down? That's really the question here. With that more moderate gain in wages on a month-over-month basis, it was only 0.2%. And a lot of the gains that we saw in jobs coming in the leisure and hospitality sector, which is the only one that is still now barely underwater compared to pre-pandemic levels. Those leisure and hospitality jobs, while we saw big gains, they tend to be lower paid jobs. So that might account for the more anemic gain in wages. The other thing that I saw a lot of economists pointing to as encouraging on the inflation front is that the hours worked, the number of hours worked, and the participation rate did not change here, which maybe shows there's not that much heat. Despite that headline number, not that much heat in the underlying numbers. And again, can you get inflation coming down?
See, that's what's interesting.
Can you get a soft landing?
Can you can the labor market stay this strong and inflation keep coming down? Because you have seen, listen, inflation has cooled, but core inflation, so excluding volatile food and energy categories, that is still well above where Jerome Powell wants it to be.
Right.
So it's certainly something the Fed is thinking about. Moving on here, major developments in the negotiations between auto workers and the United Auto Workers Union. UAW President Shawn Fain announcing a breakthrough in what he says will dramatically change negotiations. Take a listen.
We were about to shut down GM's largest moneymaker in Arlington, Texas. The company knew those members were ready to walk immediately. And just that threat has provided a transformative win. GM has now agreed in writing to place their electric battery manufacturing under our National Master Agreement.
And because of the developments, there is no expansion of the strikes this week. Automaker stocks trading near the highs of the day. And joining us now to talk about this is Arun Kumar, Alex Partners Managing Director in the Automotive and Industrial Practice. So Arun, let me get your take on the news here. Listen, UAW Sean Fain, you heard him there saying there's been progress, no new strikes this week. Is this maybe some ray of hope here, Arun, for getting an actual deal done?
Thanks, Julia and Josh. Great to be on the show. I agree. I think this is a great development for both the auto OEMs, automakers, as well as the UAW, because it allows us towards a path where we can actually get back to doing business, which is to produce cars and sell great vehicles that consumers are looking for, which is in great demand.
I had to laugh. Josh and I both had to laugh when we saw Sean Fain's T-shirt that he was wearing as he was making this latest announcement. Eat the rich. And obviously, his rhetoric has been sort of anti, quote unquote, fat cats or what have you at the top of the automakers. You know, there he is. We're showing the picture of him in that shirt again. Does that, you know, how does that factor? I know a lot of this is performance, Arun, but how does that factor into how this all gets gamed out when all is said and done?
Well, Julia, at the end of the day, you know, what you say in public is one thing, but what you do in private negotiations is a completely different thing. I think when you look at private negotiations, you're looking at basic facts and data to make decisions. And I think the crux of the matter, if you think about it, is that, you know, EVs require less labor hours to produce, which means that, you know, the UAW is concerned about how they're going to keep up with that, you know, transition to electric vehicles. And, you know, the one way of looking at this is if you bring in more manufacturing back into the UAW and into North America, it's going to help them both from producing great vehicles as well as making sure that their labor force is fully participating and is able to earn a living like they've done in the last 30, 40, 50 years.
And I did want to ask you, Arun, there was some news here today. UAW Sean Fain said apparently that they did reach a deal with GM to include workers at a new battery joint venture in a new labor contract. What's the significance of that to you, Arun? Is it meaningful?
It's pretty meaningful because when you look at a battery electric vehicle, you know, 30 to 40% of the cost is in batteries, you know, cells, modules, and then you have the entire battery pack that goes into the vehicle, right? It's like an engine and a transmission in an internal combustion engine. So till now, most of those battery production has been with a joint venture with whether companies like Korean companies or some Chinese companies, or we've been importing batteries from China. So I think, you know, having those manufacturing plants into the UAW mix allows expansion of you know, jobs that could have been lost because you have less labor hours required to produce EVs. Now you want to make sure that you're not losing more of that, you know, with batteries, because if those are outside the master services agreement, as Sean put it, then you have less and less labor that's required to assemble the rest of the vehicle. So that's been a big concern and a crux that, you know, had to be sorted out. And I think that's a great sign of progress that we have seen with this announcement.
Arun, one of the interesting things that you guys have been working on that's a big concern for your clients is riding this out and having enough liquidity to keep operating even as things are slowing down as a result of the strikes. How have you been talking your clients through this period?
Look, Julie, we've been talking to a lot of clients. Everybody's concerned about the duration of the strike and what's it going to do from a liquidity standpoint, right? We all know that the interest rates have gone up, and that's not helpful for the you know, the first-tier automotive suppliers, and especially the second-tier automotive suppliers. These are not large suppliers. They are so dependent on production humming, allow them to have money coming in terms of revenues, and then being able to order materials and pay their labor, right? So if that stops, it's going to be a huge problem for that. So in Alex, what we have done is we have developed a liquidity model that looks at several factors and kind of gives you an idea on how long each company will have from a liquidity standpoint. So when I say liquidity, is basically the cash that the company will have during the strike, and can they ride out the strike without having to go bankrupt, right? So our analysis is that, if the strike goes for 8 weeks, we're looking at about 58 to 60% decline in revenue, sales, right? We're looking at that type of time frame, it's going to be tough for a lot of the second-tier suppliers to be able to survive because cash runs out and you can't operate the companies. And we saw that during COVID as well, when money ran out, without the support of the automakers as well as the federal government, it was really hard to keep these suppliers afloat.
And Arun, let me ask you, I mean, you know this space as well as anybody. You follow this story very closely. What could a deal ultimately look like, Arun? What do you think a deal could look like that would really satisfy both the UAW and the big three?
Well, Josh, I think the crux of the question is the EV side, right? I think to me that's a big piece of it. I think with the progress that we have seen that GM and UAW make, that's a very positive sign. I think the other piece is really around the labor wages, right? Because I think in the last contract negotiations, there was a lot of give. We all know that. And, it was a shared sacrifice, if you go all the way back to 2008. And I think, with inflation, interest rates, and affordability being a problem from a housing as well as the vehicle purchase standpoint, I think it's fair to say that some part of that increase needs to be compensated by better wages. And I think in Alex, I think when we looked at the profit margins, it's pretty healthy. But again, you have to think about automotive as a cyclical industry, right? When you make profits, which has been historically significant the last 3 years since COVID, but it's a very cyclical industry, so you may not make a profit in the future, so you got to protect yourself. The other thing is, when you look at the investments that's required to transition to EVs, we're looking at $600 billion worth of investments. This is an AlixPartners estimate that the OEMs are putting in for the next several years to be able to transition, be competitive with not only just the startup OEMs, but also Chinese automakers, so that we're coming out of the other end pretty strong.
Arun, thank you so much for stopping by today. That was great insight. That was Arun Kumar from AlixPartners.
Well, thanks for having me on the show. Thank you.
And we're watching shares of Tesla trading today. They were down pretty hard, and now we have flipped into the green. The EV maker cutting prices on its Model 3 and Model Y after reporting third quarter deliveries that missed estimates. So starting price of your base Model 3, Julie, for example, that gets cut by $1,250. The long-range version by the same amount. So we know, listen, Elon Musk, he's been very upfront about the game. He's playing a volume game here. We know that. Bulls are weighing in, by the way. Dan Ives over at Wedbush, great friend of Yahoo Finance. Dan is saying his view is that the vast majority of the price cuts are now done. The worst, he's saying, is in the rear view mirror.
Yeah, whenever these price cuts happen, it's the game among investors, I think, as well, between the volume question and the margin question, which has been one that has dogged Tesla thus far this year, and perhaps why you're not really seeing much stock reaction, interestingly, here. Nope. The stock has kind of bounced around over the course of the session, and it's bounced around over the course of the week as well. I should point out, we're going to hear much more from Tesla on October 18th. That's when the company reports earnings. And so it feels like at that point we could get a little more guidance around what cuts are going to look like. But I will say, by the same token, this company's guidance, I won't call it worthless, but you can say it in a positive way that Elon Musk is very flexible when it comes to how he handles his companies.
Yeah, that does sound
or you could say he's difficult to predict. From an it can be, I guess, an asset or a liability, depending on how you look at it. But he will likely say something one way or the other about the pace of pricing from here and the effect it's going to have.
And we will be listening closely.
We will. Let's also take a look at shares of Shale Driller, Pioneer Natural Resources. We're watching that today surge by almost 11%. That's after a report from the Wall Street Journal revealed that ExxonMobil may buy the company in a deal valued at around $60 billion. There have been some reports in the past that the two companies were in talks. This is the one that seems like it is most imminent here. And this, at $60 billion, would be a monster deal for ExxonMobil. The company did buy XTO in 2010 for $30 billion. And of course, it bought Mobil way back when in a huge deal. So this would actually be the biggest since that.
Yeah, from what I was reading, this would make Exxon the largest Permian player. So it is a huge deal. You look at the stock too, Exxon, remember surge in 2022, energy prices rocketed higher, Russia invades Ukraine. This year, not so much. We're actually negative year to date for Exxon.
Yeah, and it's been such an interesting moment in oil over the past several years because you had this whole narrative before the pandemic in the oil patch that things were really turning the corner in terms of alternative energy sources, in terms of moving away from shale. And so this also signals an investment in that industry, if indeed it happens, an investment in that industry that we're still going to be reliant on oil for a little while yet.
A bet that it stays strong.
Yeah, exactly.
And finally here, shares of Disney, let's check that out. Trading higher, the move coming on the heels of an analyst call at Bernstein initiating the stock at a buy with a price target of 103. The analyst writing Disney is, quote, the only credible challenger to Netflix. Here's my favorite part about this report, Julie. I like when the analysts have a little fun with their reports. I can understand why they're spinning these models all day. Here's what he says. He says, because really this was an initiation on media and telecom, so it was a bunch of names. But basically, does initiate Disney outperform? Only credible challenge to Netflix. Thinks Disney should command a premium and writes, my young associates do not understand how cable remotes work. And that pretty much sums up the future of pay TV as is. Try explaining the cable bill to a Gen Z.
That is amazing, and I love that commentary in there. And I love also that the name of this overall note is Everything Everywhere All at Once. Of course, the name of a movie as well. That is the initiation on this area overall. If you look at Disney shares and how they're reacting to all of this, they're up almost 3% in today's session. So it looks like a little bit of positive reaction to that. I, for one, I'm going to be watching the first episode of the new season of Loki tonight.
Really?
Which I believe just came out last night. Big favorite of the family. It's really good.
Does everybody get on that?
Everybody watches it together.
Kids,
We all watch
Sparky?
it together. Sparky sits with us, and his face sometimes points towards the TV.
Good dog, Mom.
It's a good one.
Good dog, Mom.
All right, we're just getting started here on Yahoo Finance Live. Coming up, cybersecurity. We're going to speak to Okta CEO Todd McKinnon about the company's latest efforts to battle cyber threats using AI and going public. Sandal maker Birkenstock expected to go public next Wednesday. We're going to break down what matters, what makes this IPO different from other recent debuts. And after the break, we're going to dive further into the latest jobs report and the impact it could have on you. All that and more when Yahoo Finance returns.
Stocks reversing early declines. The Dow, Nasdaq, and S&P 500 now having their best day since August. Bond yields are also heading higher, with the 30-year yield hitting 5%. That's for the first time since 2007. What does this mean for stocks going forward? Yahoo Finance's own Jared Blickery crunched the numbers, and he's here with the results. Jared.
It's looking like more bullishness ahead, and maybe this correction is over. Let's go to the Wi-Fi interaction, where I'm first going to chart what's happened in the bond market today. We are up 17, 18 basis points. That was at the highs here, but we are off, but we're still up about 7 on the day. And that's a little bit unusual considering what's happened with stocks. Stocks don't seem to be phased at all by bond yields screaming higher. Here's the S&P 500. I'm going to show you what it looks like on a 3-month chart here. You can see we are coming off that much vaunted and talked about 4,200 level, and now we are having the best day in weeks. It is a similar story for the tech-heavy Nasdaq and also the Russell 2000, which has been the weakest of this group so far. As you said, I have crunched the numbers, and whenever we have payrolls day like this, up more than 1% in the S&P 500, it's kind of a split, 50-50 going out 1 day, 2 days, 1 week when it comes to percent positive. And the results aren't spectacular, but you go out a month and a quarter, results improve to about 72% positive. 1 quarter out, we're looking at average gains of 3.3%. Kind of a similar story to the Nasdaq, but a little bit better when we consider the short-term probabilities. Now, when we add in the movement in the bond market, and we consider that we have also moved up 5 basis points, as well as S&P 500 up more than 1%. The results improve to about 60% over the next 1 and 2 days. They stay about the same for the Nasdaq. Despite all the numbers here, I think the conclusion for me is we're looking at probably bullish results looking forward. This was not too hot a report to really spook the equities markets. We'll have to see what comes on Monday, but if you'll recall, one of the theses from the interview I had with Alfonso Picatiello over at the Macro Compass was if we came in too hot or too weak, this was going to be very bad for equities. You consider the headline payroll number was very strong, but the wage growth and the unemployment statistic, those were a little bit weaker than expected, and I think that's just giving the green light to equities here to continue their rise. Now, here's the Nasdaq 100 on the Wi-Fi Interactive today. I want to show you what has happened for the week. The mega caps really surging here. It looks like everything up about 3, 4, 5%, NVIDIA up 5, Tesla 4, Meta 4.7, list goes on, and you take a look at the sector action, kind of split there. Interesting that we have tech up almost 3% and then communication services followed by healthcare, but more concentration, more love for the mega caps, and we'll have to see if the rest of the market can follow in the days ahead.
Yeah, and on the flip side, energy not faring well as we saw oil prices tumble. Jared, thank you so much. Really appreciate it.
You bet.
Shock and awe. The U.S. economy adding 336,000 jobs in September, nearly double what the street was expecting. And with today's blowout jobs report, every major sector except leisure and hospitality has now recovered to their pre-pandemic employment levels. For more on September's jobs report, we're joined by Julia Pollack, ZipRecruiter chief economist. Julia, thanks for being here. It's been so interesting to me over the course of the session to see the perception of the jobs report kind of change here. And I'll ask you the question that's now on our minds that Josh posed earlier, which is, can you get disinflation while still seeing a job market that is growing like this?
So that is the big question, and that is why markets have been so topsy-turvy today. We have all thought for the longest time that there was a big trade-off between inflation reduction and the labor market. And what the past year has told us is perhaps there isn't. We have seen jobs grow. We've added 3.2 million payrolls over the last year. The household report has shown an increase of 2.7 million employed Americans, while we've seen a meaningful reduction in inflation. The last 3 PCE inflation reports that the Fed tracks most closely were very encouraging, with core PCE inflation just above 2%, very, very close to the Fed's target. And this wage growth number, if you zoom in on the last 3 months, it's just 3.4%, perfectly consistent with 2% inflation.
So, Julia, let me ask you this. So this was a blistering report, crushed expectations, but what's your outlook, Julia, for the U.S. labor market from here?
So The official estimates of what's going to happen next don't look so great. If you look at the Congressional Budget Office, if you look at the Fed's SEP, their projections, they all think that unemployment is going to rise. But if you went back a year, that was the case, and they were all proven wrong. The Citibank surprise index has been in record-breaking territory because we've all been getting it wrong for over a year now. And so I think there's tremendous uncertainty. We just don't know. We know that interest rates are holding back many, many families from buying that new home they would love to buy but cannot afford to buy at these rates. We know that many businesses are putting their investments and their new projects on ice. They come to us and tell us that they really want to hire for new roles, but they're nervous about what the future holds, and so they're holding back right now. How much more would this labor market be growing if it weren't for the restrictive rates that we're seeing? That's, I think, an amazing question to ponder.
That is an amazing question. Well, you work at a place that also has some extra insight into all of these issues, right, at ZipRecruiter. And so I'm wondering what your own internal data is telling you about what's happening with the pace of hiring and any kind of forward-looking indicators.
Sure. So online job postings across the web are just about right back to their pre-pandemic level. And that's consistent with the official data, too, that shows that quits rates, hires, that pretty much all of the key labor market indicators are back to normal, back to a sustainable, healthy, positive place. We also know that the sentiment data has been very, very weak, and our surveys of job seekers show why. They're feeling unprecedented financial stress. And so while many, many workers are seeing lots of opportunities, they think those opportunities just aren't enough to help them keep maintain their household spending.
And Julia, if you look under the hood of this report, there was just some interesting moves in the different industries and sectors. Private sector job gains here, they were driven in September by leisure and hospitality, added about 96,000. Restaurants, economists are pointing out, have actually finally returned to their pre-pandemic peak. What's your outlook for that? First of all, I guess, Julia, what explains some of those trends in that sector, and what would be your outlook going ahead for it?
So I think it's important to note that leisure and hospitality, and restaurants, while they've returned to their pre-pandemic employment level, are far below their pre-pandemic employment trend. Were it not for the pandemic, restaurants would have grown and boomed and added more than 1 million jobs by now. That is an industry that the Bureau of Labor Statistics expects to add a very, very high number of jobs over the next decade. It's one of the fastest growing sectors. Americans like to go out and eat. So this industry, it's almost a miracle that it has recovered to the degree that it has, because it was so heavily disrupted during the pandemic. It's not as though all the jobs have come back. They have shifted. There's been a large decline in full-service restaurant employment, more than 200,000 jobs lost, a big increase in limited-service restaurants, cafeterias and buffets, the places that serve office workers, they're down 35%. So what it shows, I think, is that this industry has pivoted, it's adapted, and it's managed to find a way to meet demand where it is.
We were talking earlier about some of the other indicators within the jobs report as well, things like hours worked and the participation rate, the household survey, and some of the indicators within that. Are there any areas there where you think that we will see some further improvement, or I guess negatives, depending on whether you're the Fed?
So this month, the household survey was flat. Nothing really happened there. But if you zoom out, it's also a pretty strong report over the past year, and it has shown meaningful improvements in participation and employment population ratios. The unemployment rate is an interesting one, but I think what it shows there with a 3.8% rate rather than a sort of record low 3.4% rate is that this economy is no longer overheating. It is in a sustainable place. Anytime the unemployment rate is below 4%, and it's been there now for about 2 years, that's a good day for the American worker. We see good things happening in the labor market. We see more people coming in off the sidelines long term when unemployment is that low and the labor market is that tight, because employers are forced to be more flexible. We're seeing employers cut requirements for jobs, raise benefits, and pull out all the stops.
Julia, thank you for speaking with us today. That was great insight. Appreciate it. That was Julia Pollack, ZipRecruiter Chief Economist.
Thanks, Josh.
It's not just stocks on a wild ride this week, but the driver of the market action has been bonds. Yields on 10 and 30-year bonds hitting fresh multi-year highs on the back of that jobs report, but have since come down. Joining us now is Bryce Doty, CIT Investment Associates Fixed Income Senior Portfolio Manager. So Bryce, let me first of all just get your take on the news today, a blockbuster jobs report. Investors are sending the indexes sharply higher. I just want to get your take on that report, Bryce, and importantly, how you think the Fed is thinking about that report.
Yeah, we've been constantly expecting a stronger job growth to come with lower earnings. So we just see it as a supply-demand thing. You know, I understand that the Fed is used to an economy where, you know, the only time you ever get inflation is when everything's overheated. And you have too much demand. It's demand-driven inflation. I think Americans are just kind of like used to never having shortages. You can always get fresh strawberries every day of the year. But we experienced shortages during COVID. And so if you have a shortage of labor, you're going to have a lot of inflation. You're going to have supply issues everywhere. And so as everyone starts working again, you crank up the supply, the inflation just kind of subsides. So we were fully expecting this trend this year, even though we didn't expect this many jobs today. It's disinflationary. If you have a lot of people going to work and you have a huge supply of workers, well, it doesn't cost you as much to hire them. You don't have to give them as big a raises. So that hourly earnings coming in at 0.2 is consistent with the last 3 months. We're now running at an annualized earnings rate that's less than 4%. If people are 2% more productive a year, which is pretty regular, that's what you can expect, then you only have to raise prices by 2% if you're a company, right? And that's if 100% of your expenses are labor. But if you look at goods, they're only running about 1.5%. So you don't even have to raise prices by 2% to keep your profit margins going. But the Fed, you know, you make a good point, and other economists, they just are looking at it as though it's, you know, it's bad. It's bad to get all these workers into the workforce. I just don't understand that. Because the PCE, the Fed's favorite indicator, core PCE, is running at 2.2% if you look at the 3-month annualized number. And that has happened despite higher than expected jobs numbers month after month after month. Whereas I think that just makes sense. I mean, maybe if you have a PhD, you can't follow that. But if you have more supply of labor is going to become less expensive.
So, Bryce, bottom line, if the Fed raises rates again, are they making a mistake?
Yes, I think the increase in rates is bad. It's made it harder for businesses to hire people. The economist you just had on, she made a great point by just questioning. I think she knows the answer to this. She said, just think how many people would have come back into the workforce sooner and how many more had the Fed not done anything. I mean, we would have more rapidly corrected the supply-demand imbalance and gotten rid of shortages much, much quicker if they had, acted sooner and moved slower and helped businesses be able to plan better. It would have been less shocking to everyone. As it is, it's been extremely disruptive. You've really hurt banks, you've hurt lending, you've hurt the ability for companies to manage inventory, be able to finance inventory, which makes it even more difficult and more expensive to hire people to resolve the supply shortages and whatnot. So they can only affect demand. So they're a one-trick pony. They weren't even thinking about, hey, maybe it's a supply issue. And the supply problems were created from the fiscal side of stimulus. And so the Fed's trying to, fix a fiscal problem using monetary policy. And it just has not worked very well at all because they can only impact demand, really. And that isn't the source of the problem.
Bryce, I want to get your response and reaction to a note from B of A's Michael Hartnett. Mr. Hartnett speaks, people tend to pay attention. He says bonds will stage a comeback in 2024, that as higher interest rates send the economy into a recession. What he told his clients is once the recession being priced by bond and stock markets mutates, he says, into economic data, bonds rally big, and bonds should be the best performing asset class in the first half of 2024. That's Michael Hartnett of B of A. I want to get your reaction to that, Bryce. You think he's right?
I think he is right. I think that the bonds could be a great investment without even having that dire situation come to pass. Our core bond portfolios right now are yielding about 6.25%, 6.5%. If that the run rate for core PCE continues at 2.25%, that's a 4% real yield. I can't remember the last time we had that. I don't know when we'll get it again. I think it's a fantastic opportunity, and that gap will have to narrow probably in 2024, exactly when he says it will. And if there is a significant weakness in the economic activity, on top of that, just think how rapidly that gap will close. And that will happen with yields coming down quite a bit. The duration of the aggregate bond index is 6. If rates go down 1%, that's a 6-point gain on top of the 6% yield you're already getting. All right, that's a 12% year. That's pretty nice in bonds. And it'd be tough for other sectors to really be able to compete with that, given that that poor economic scenario that he's using.
Bryce, thank you for that insight and guidance. That was Bryce Doty from SIT Investment Associates.
Thank you.
And coming up, recent cyber attacks on companies like Clorox and MGM are having a big financial impact. We're going to hear from Okta CEO Todd McKinnon on companies' efforts to fight cyber criminals using AI. That is next.
Welcome back to Yahoo Finance Live on this Friday afternoon. So much focus on AI and the speed in which companies are rolling out AI. And now a lot of companies are looking to protect their platforms into 2024 as this new technology rolls out. Of course, who better to talk to than Todd McKinnon, co-founder and CEO of Okta. Todd, good to see you. I know you're fresh off your 11th annual Octane event where you rolled out a bunch of new products. What exactly did you bring to market here, and what are your goals with some of these new products?
Yeah, it's great to be here on Yahoo Finance, Brian. Thanks for having me. Octane 23 was all about Okta AI. Okta AI is AI capabilities infused across our entire product portfolio. It makes several of our existing products more valuable and more powerful for customers, and also makes entirely new products possible. So we were able to talk with customers and partners and connect with them and really talk about this next wave of technology, which is the AI wave of technology, the AI revolution. And it's going to pervade every industry, every company. We used to say that every company is a technology company. Now every company needs to be an AI company, and we're helping them with Okta AI.
We've been talking all day long, Todd, about what's happening over there on Clorox. And I would argue they're really not an AI company, and they sell bleach. But if you are a company right now rolling out new AI initiatives, is it almost next to impossible to protect your platform from people who might be trying to hack you from their mom's basement?
Well, the attackers are coming after everyone, and every organization, every company, every government system is under attack. And that's because as an industry, we've done so well at digitizing so much information and making processes online and connecting more closely with our business partners and consumers. And that all has tremendous benefits for the world, but it also has the downside is that it raises the risks and the value that an attacker can gain by compromising these systems. So it's up to the industry to adapt and build better capabilities. As the threat actors get more sophisticated, the industry has to get more sophisticated. And now this whole new AI revolution is going to be more capabilities, like we talked about Okta AI across our platform of products, but the threat actors can use this technology too. So you really need this ecosystem. You need this ecosystem of companies that are working together to protect all of your applications and services and infrastructure. And it can't be done by one company. It's got to be this collective ecosystem, which is something we're very focused on in our product strategy.
It sounds like a pretty scary future. I mean, AI, of course, lots of potential there, but you're raising the risk of potential hacks. What's your pipeline of business? You know, a lot of these new tools, of course, you rolled out today, but what's the customer appetite to give you money so they get access to these new tools?
How it's really evolved over the last few years is very interesting. 5 years ago, when we would have had this conversation, identity was a conversation about employee enablement, make it easier to log on to systems, or maybe make it easier to roll out a new service or application or cloud infrastructure. Or it was about building a new website and building it faster. Now it's much more of a security focused conversation. I think what's happened is that with the firewall being less important in the security conversation, and with people working remotely and more people adopting cloud technology faster, it's very clear that identity is at the center of this all. And if you want to have a comprehensive and strong security posture across your employee base and your partners and your extended ecosystem and your customers, you have to have a solid identity platform at the center of that. In fact, when I talk to CEOs and boards of directors now, this is a board level conversation. How can we get our cyber house in order? And then how do we do that by picking the right identity partner?
Big jobs report, Todd, 336,000 jobs created on the headline. Does it feel like to you that type of strong economy, and do you have visibility into how your business could fare next year? Does it feel as strong as some of these numbers we've been talking about today?
So our business is driven by these long-term secular trends I mentioned, the need for more cyber and identity being at the center of that, cloud transformation, AI as the next technical wave, and identity is going to be more important ever in the future. When you get down to the specific economic anecdotes and inputs we see in our business, a couple of things are clear. One is that the companies are having higher scrutiny on their spend than they did 3 years ago. 3 years ago, it was zero interest rates. People were buying everything. And then for the last 18 months or so, companies, CEOs are trying to do more with less. 84% of CEOs think there's going to be a U.S. recession. So whether or not there will be, and this jobs report is further evidence that the economy is likely going to grow this year, and you can talk about the recession or not, but a lot of people think there's going to be a recession, which means they're being more scrutinous in their spending. They're expecting more ROI from their investments. And I think luckily for us, identity is passing that bar. So it's not only those, it's as companies get more scrutinous on spending, they're still investing, especially larger companies are investing in their identity projects.
Like any company, Todd, the road to success is never a straight line. And we've talked in the past about your challenges along the way, your company's challenges with the sales force or integrating an acquisition that you made a couple years ago. But at this point, does it feel like to you, from the lens of a co-founder, that you have your mojo back internally?
I think one of the things about being a founder is that you got to realize that you have to keep your own mojo no matter what's going on in the industry or in the company. You got to lead the company and drive it forward with a lot of positivity and a lot of energy. So I always think we have our mojo. I think if you look in the company now and you look in the customers, and especially at an event like Octane that we just finished up, the buzz around the partners and the customers, we had, over 4,000 people in person and, a few times that online, taking in this message and realizing that this AI future is very promising and there's a lot of great things that are going to come out of it if we have a good technology stack to take advantage of it, and we balance some of the risks we talked about with the tremendous opportunity. And it feels really good.
All right, well, we'll leave it there. Okta CEO Todd McKinnon, always great to get some time with you. Have a great rest of the week. I know it's been a busy week.
Thanks, Brian.
All right, much more ahead on Yahoo Finance on the other side of the break.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard
hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Birkenstock to join the growing list of high-profile public listings such as Arm, Klaviyo, and Instacart, footwear company making its debut in a shaky market for initial public offerings. That burst of activity in September yielding fairly muted performances, with Instacart and Arm shares sliding since their IPOs. Here with more on where the market stands as Birkenstock gears up for its IPO, we have Barrett Daniels, U.S. IPO Services co-leader at Deloitte. So Barrett, let me ask you this. We've had this trickle of IPOs, as we mentioned, Arm, Instacart, Klaviyo, Birkenstock going to test the waters. Do you expect to see, Barrett, a pickup of IPOs in the near to intermediate term here? And what are the factors and variables that determine that?
Yeah, look, I think Q3 was good. We raised more IPO proceeds in Q3 than we did in all of 2022. So there is momentum. Right? Things are picking up and heading in the right direction. But at the same time, if you are a company on the fence, I'm not sure that the results here recently were super alluring. So I'm not super bullish here on Q4. I'm still wait and see mode for sure. I am more hopeful about, let's say, Q2 and traditional IPO season of 2024. But I think the jury's still out, and we still have it's still wait and see approach, at least most of the folks that I'm speaking with.
You know, Barrett, it's interesting that you bring this up because it has felt like every new IPO is going to be the one that's going to be the make or break for the IPO market and get everybody to come back in. Arm was going to be it, and Instacart was going to be it, and you know, maybe I don't know if Birkenstock is going to be it, but it's felt like a lot is riding on each of these, and then they kind of come and go and nothing changes. I mean, Birkenstock also seems a little anachronous compared to some of the others, it being a much more an older company, for example. Is that sort of the wrong way to think about these?
Well, look, I would say it's not a perfect IPO window, but it's a window, right? And so I would say the demand is there, the investment demand. But the question is who's ready to go? And I don't think the pipeline is quite where we thought it was. And often, too, the recoveries from IPO slumps are often V-shaped. And so I think a lot of us thought that that's how this one was going to play out. But now it's starting to feel more like it'll be a gradual acceleration as things slowly return. Because, you know, with where the interest rates are right now, you have to have a very compelling story to be able to get out in a market like this, because you can literally earn 5% by just sitting on the bench and doing nothing. So we still need some of the better ones, but frankly, I don't see the flood that I was hoping for, let's say, a few months back. But I definitely see momentum, and I definitely believe things are headed in the right direction. It feels pretty clear that the worst is behind us at this point in time. But at the same time, not sure about any V-shaped recovers and probably more of a gradual acceleration.
Barrett, what are the funding conditions in the private markets right now? In other words, you know, companies might be coming public more often if they weren't able to raise money in the private market, so saw the public market as an alternative. What's going on the private side?
I think companies are still having challenges raising money on the private side, and they're starting to get a little creative. So like triggers and terms that we see in capital raisings years ago, 10 years ago, and so are sort of coming back to life. A lot more convertible notes, a lot more of liquidity factors like baked into these deals. And so we are seeing a change in the environment. But really, at the end of the day, I'd say both the private and the public markets, it's going to come down to valuation. And we see a real spectrum of views on company valuations, with some CEOs and CFOs saying, seeing the environment very clearly and just saying, our valuation has to come down, right? Like, there's only a couple of real triggers in a valuation. One is revenue growth and the other is market comps, your comparable companies that are already public. And if your comps are getting slashed and getting hammered by 50%, it's a really hard story to make that your valuation hasn't changed. That said, there are some CEOs and CFOs that are reluctant to write down their valuations and feel like it's just, if they just wait it out, they will be able to grow into it. And that might be right. But really, I do think valuations are going to continue to be a factor for anybody trying to raise money in the private or public markets right now.
Barrett Daniels, thanks so much for your perspective. We're looking ahead to one more IPO next week. Thanks.
Yeah, thanks for having me.
Coming up, we've got the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned. There you have the closing bell on Wall Street on this Friday. Looks like markets snapping a losing streak. The S&P 500 up for the first week in 5 here with this strong finish on the week here. Although the S&P equal weight, our Jared Blickery points out, still down for 5 straight weeks. Interesting there. The Dow up about 0.9% on the session, about 288 points. The S&P gaining 1.2%. The Nasdaq up by 1.6%. All of this, of course, pretty dramatic reversal after the jobs report, which coming in better than estimated on the headline, raised concerns about the Fed having to be more aggressive to tamp down inflation. But then as the day went on, the read seemed to be, well, maybe that jobs report wasn't so unfriendly to the idea of inflation coming down after all. So interesting reversal on the day. Let's also get some interesting movers that we're watching. Levi Strauss slashing its full year sales guidance. The company citing challenges in its wholesale channels like department stores and big box retailers. Those shares, though, finishing the day down not by that much after earlier falling by much more, off just about 0.8%. So interesting, Josh, even as we saw the overall reversal, maybe a little bit of pairing of declines for Levi's too.
Yeah, and the worry on the street doesn't seem to be direct to consumer. It's really about the wholesale business. When you look at the analyst commentary, I think Wells Fargo sums it up pretty well. What the street seems to be feeling here, they're saying the stock is cheap, but with wholesale headwinds, near-term setup, in their words, tough.
Yeah, exactly. So there doesn't seem to be a lot of optimism around the wholesale channel there.
Right.
So it's interesting that we didn't see the stock doing worse. We did earlier in the session, earlier in the day, our Brad Smith and Sean Smith talked to Harmeet Singh, who is the CFO of the company. He did express some cautious optimism about where the direction is going for the company. So maybe, some investors sort of listening to the tone of commentary from the company and not feeling quite as negative.
All right. MGM, how about that one? Resorts offering an update on the impact of the cyber attack experienced last month. Company expecting the data breach to cost its business more than $100 million. However, MGM noting it believes the incident will have minimal impact in the fourth quarter and operational results for the year. So this one, and interestingly, Julie, the Journal reporting that MGM refused to pay the hackers' ransom, which is what the FBI apparently advises. But the price tag, as we know, $100 million in the third quarter. But you saw investors move in there, the stock popped, and I think it's because investors who cover the name say they don't think that attack is going to have a big impact moving forward.
Right, exactly. And the stock has already been selling off as of late, so the bounce then, when the worst fears perhaps were not realized here. If you look at some of the analyst commentary, Truist saying that limited net financial impact from the cyber attack, that is, that was indeed a relief there. Also, some analysts talking about looking into the fourth quarter, as you said, the future.
Yep.
We're not going to see necessarily an impact from that. So
rearview mirror stuff.
Yeah, yep. Exactly. Let's talk about e.l.f. Beauty as well. ELF shares popping after an upgrade from Jefferies. The firm raising its price target on the company, upgrading the stock to buy from hold. Jefferies saying the cosmetic company's underlying demand remains robust here, and that the stock has pulled back lately, so that made its valuation look attractive here. It's been expanding internationally. The stock, as you remarked earlier, has already been on quite a tear this year.
Yeah, so Jefferies likes it because, listen, they see an opportunity after a pullback. They like the international expansion. Price target now for Jefferies is $115. But yeah, investors, by the way, have already piled into this name. Year to date, this thing's up more than 80% already.
Wow, and look at that one-year chart, 158%. There has been this sort of conventional wisdom and narrative that makeup would perform better in a downturn. That has proven true to some extent in a lot of the earnings reports that we've gotten, right? That, it's the little luxuries that people will hold on to.
It's a thing you don't want to give up.
Yes,
right?
Exactly. So we'll see if indeed, two ifs, if indeed the economy can, does worsen, will we then, if that happens, will we see this this trend continue?
All right, we shall see. And some of the biggest stocks on the move this week are consumer staples and some retailers that sell lots of food. The concern is that the popularity of new GLP-1 drugs, including Ozempic and Wegovy, could dent sales. Some of the hardest hit names include Coca-Cola and PepsiCo. So this is interesting, Julie, for a lot of reasons. It's a great story. One is analysts say that only about 1% of U.S. adults have prescriptions to these drugs, right? That's what we're talking about, 1%. And there's lots of good reasons for that. It's access, it's affordability, it's side effects. But already investors are thinking, what's the uptake rate and should I be worried?
this has just been an incredible week for this story. It sort of reached a fever pitch this week, right? If you take a look at the Wi-Fi Interactive, I'm going to take another look at that Consumer Staples Fund, right? So this is today's session. Consumer Staples, the only group in the red on the day, which is pretty incredible. If you look at the Dow components on the day, and I'm going to do equal weight so it's easier to see what is down, Walmart, Walgreens, McDonald's, right? These are the things that are now selling off as a result of this. And then if you take a look at things like food, you're seeing it there as well here. Again, if you look at equal weight, Pepsi and Coke coming back a little bit today after falling, but Mondelez down. Like, all of these food companies are trading off. We have been seeing it happen in beverages as well, and we've been seeing it in fast food. And it's like, at what point, come on, if the exposure is only, if only 1% of people have prescriptions for this stuff, even if that goes up, right, is it really going to have this kind of effect? Bank of America, the latest out today, saying that food and beverage, alcohol, snacking, and non-alcoholic drink companies are most at risks if their function is no longer relevant.
Yeah.
But this is quite a leap to get from weight, or they're talking about weight management products function no longer being relevant. But what kind of leap are we taking here from 1% of people having these prescriptions to weight management of other types of product, like a whole category becoming irrelevant?
Yeah.
And we've heard stuff like this before in the past with other types of weight management drugs. And yes, perhaps this class of drugs is that much more revolutionary, but I would just question the reaction that we have seen in the market.
It is interesting because the uptake rate, by the way, there's all kinds of variables that are going to impact that, like insurance coverage, for example, right? So you don't know where it's headed, but it's fascinating the degree to which already CEOs are getting grilled on it, and investors have a ton of questions, and analysts are responding.
Yeah, and the next one that we're going to probably hear from, by the way, Pepsi is the first in this bucket of companies to report its earnings. It's due on October 10th, and so for sure they are going to get
a lot of questions on the call about that.
Yes, because of course they make snacks, not just drinks. All right. Speaking of food, let's talk about Conagra Brands, closing higher today after the stock hit its lowest level since 2020 on Thursday following its fiscal first quarter results. The shares up 1.5% today. The company did beat on earnings but missed on revenue as sales of refrigerated and frozen items dragged. Yahoo Finance's Brooke De Palma, Brooke, has the details for us. Oof, save me, it's Friday, Brooke. What's going on with Conagra?
Good afternoon, Julia, and certainly happy Friday to you. Conagra is known for those frozen brands like Bird's Eye, like Marie Callender's, as well as Healthy Choice. And what we saw last quarter is a bit of a shift in consumer behavior. We saw sales of those refrigerated and frozen items drag a bit down 4.6% last quarter. Volume also down, get this, 10.5%. Now, as I just mentioned, we're seeing shoppers turn to less convenience. We're seeing see them make more meals by themselves at home, all in an attempt to get more bang from their buck here. And we heard from Conagra CEO Sean Connolly say on a call with investors that most of the frozen items we sell are frozen convenience items. What you've seen over the last quarter is more of this pivot to what we'll call meals for many instead of meals for one. And he went on to say that it's more of a speed scratch type of thing where you can stretch your buck and feed more mouths. Now, speed scratch is when you combine fresh ingredients with ready to eat ingredients. But overall, Conagra looking to win back volume, looking to win back consumers that maybe pulled back this past year due to higher prices. They say that they look to improve volumes by the back half of 2024 with promotions as well as advertisements. But Stifel analyst Matthew Smith saying not so fast here. He said that the dynamics leading to the current consumer environment are nearly unprecedented. And he added that goal to return to higher volumes in the back half of 2024 is a bit ambitious.
And Brooke, taking a step back, what sort of demand are we seeing overall, and any stocks investors should keep their eyes on here?
Yeah, well, it's certainly been quite a few years since the pandemic where we saw a surge in frozen food. Now, for the past years, we're seeing those sort of pare back. We're seeing volume unit sales really decline, down nearly 5% year over year, down nearly 4% the year prior. And analysts are saying that convenience is strong when the economy is strong. And now with the stressed low-end consumer, we're not getting that benefit as much as we were before. Yet we're seeing companies go all in. Kraft Heinz just recently introduced a grilled cheese Lunchables, a frozen category there. They're dubbing this new platform 360 Crisp. We also saw J.M. Smuckers continue to bet big on that frozen to thaw Uncrustable. Mark Smucker, CEO there, just recently told us that they're set to reach $800 million in sales this year. They're building a third plant. They expect lots of growth. And so now we just need to get that momentum and innovation to meet that demand.
Brooke DePalma, thank you. And today's data showing a hot jobs market would usually be a positive sign for the sitting president, but rising interest rates are getting in the way of Biden calling it a success. Shock rise of more than 300,000 jobs last month saw Treasury yields reaching 5% today, many expecting further rate hikes next month. Rick Newman, senior reporter at Yahoo Finance, joins us now. So it's bad news for Biden, Rick?
Biden correctly says all the time there's been record job growth during his administration. That's true. And voters are giving him no credit for it. And I don't think today's going to make any difference. I mean, it's like there's always something else that is bumming people out. For a while, obviously, it was inflation. Real incomes have not been keeping up with prices. And now look what's happening in the bond market. Most voters don't follow the intricacies of the bond market. But we've been talking about it a lot, and this is fairly serious. I mean, because interest rates are creeping up more than would be suggested by what the Fed is doing with short-term rates. So we've now got the 10-year Treasury closing in on 5%. Mortgage rates are up to 7.5%. That is the highest in 23 years. This means other types of consumer borrowing costs are going to go up. And this may be, I mean, the bond market doesn't explain exactly why it does what it does, and everybody's trying to figure this out. But this may have something to do with that gargantuan pile of U.S. debt, which is really has been flooding into the bond market for the last several years. And maybe that is part of the reason that interest rates are going up. So the question is this the beginning of something terrible, or is this just a blip that will resolve itself? We don't know. But I looked at President Biden's approval rating today. It is now drifted under 40%. If you look at the aggregate of polls, it's around 38 or 39%. That's bad going into a re-election campaign. And that is despite a terrifically strong job market. Biden just is not catching a break here.
So, Rick, let's switch gears here, because I saw a story today and I thought to myself, I need Rick's response to this story. So here's the story, Rick, from Politico. They say LinkedIn co-founder Reid Hoffman convened a Zoom call, Rick, with other like-minded donors, and they wanted to address a persistent fear among national Democrats. That's Politico's words. And the fear is, Rick, third-party candidates who could undercut Joe Biden's campaign. So we're talking here about, Robert F. Kennedy Jr., if he was deciding to run as an independent, or Cornel West. How much of a threat do you think that is to Biden, Rick?
Listen, everybody in the Democratic Party either remembers or knows that Ralph Nader's run as an independent candidate in the year 2000 may have cost Al Gore the election by taking just enough votes in Florida to give that over to George W. Bush. So this is not a concern about the Democratic primaries. Nobody has a challenge for Biden in the Democratic primaries. But if there is a candidate in the general election who could get 1% of the vote or less. I mean, we have swing states that decide the entire national presidential election these days that are determined by less than 1% of the voters. And if a candidate there gets less than 1% and all of it comes from Biden, or more of it comes from Biden than his opponent, Donald Trump or whoever it would be, that could turn the state and the whole election against Biden. So it really does come down to what seem like infinitesimal numbers of votes. Now, there was some good news for Biden this week, which is that Cornel West said he's not going to run with a party, which would be something like the Libertarian Party or the Green Party. Those parties, whoever the candidate is, they tend to get a little bit of the vote because they're sort of like established third parties. He's not going to go that route. He's going to just run as an independent, which analysts think is good news for Biden because it's less likely that people will vote for him because he doesn't belong to a party. Same with RFK Jr. So those are favorable developments for Biden. But look, the Biden campaign and everybody who wants Biden to win, they are going to be on this like a hawk to make sure there is the small, no openings for some kind of squeak or surprise win by whoever Biden ends up running against.
Rick, always love having you on. Have a great weekend.
Bye, guys. You too.
And coming up, we're wrapping up week one of the trial of crypto king Sam Bankman-Fried. We're going to catch you up and bring you all the latest developments. That is next.
The auto industry is facing its biggest transformation in decades, electrification. And it's not just Tesla shaking things up. The ripple effects are being felt from the factory floor to the driver's seat. And it hasn't been a smooth ride between supply shortages, the auto worker strike, and high prices. The road to broader adoption is filled with speed bumps. Yahoo Finance has the manual on the top issues facing the industry for both investors and drivers in our special series, EVs, The Road Ahead. It all starts on October 9th, right here on Yahoo Finance.
Today, we've been hearing some of the most damaging evidence so far in the high-stakes criminal fraud trial against FTX founder Sam Bankman-Fried, and it's coming from people who know him and the company best. Giving testimony about the now bankrupt exchange was Gary Wang. It was Bankman-Fried's childhood friend, college roommate, and co-founder. Justice Department says Bankman-Fried defrauded FTX customers by illegally dipping into their funds to prop up his crypto hedge fund and spend on lavish real estate. Yahoo Finance's Alexis Keenan has been in the courtroom today. What is the latest, Alexis?
Yeah, so this was the fourth day of the trial. So far, Sam Bankman-Fried, he's faced 4 different witnesses, 2 of who you just mentioned, close, longtime friends, college roommates at MIT, and also just longtime friends from childhood, one of them. But you talked about Gary Wang, and he and the other friend, Adam Yedidia, they're both software developers, and they both worked at FTX as well as Alameda, and they go all the way back to to the company's founding and all the way back to 2017, 2019. And Gary Wang is a key to the government's case. He's the one who was up on the stand yesterday and today. And this is what he said. He said that the way that these two companies were set up allowed for Alameda to have special privileges to FTX customer deposits. And the way that Gary Wang said that this was done was that he was instructed by Sam Bankman-Fried to write special computer code that gave Alameda special privileges. And here are the privileges that he talked about. He said, for one, there was unlimited access to FTX funds because Alameda could carry negative balances, unlimited negative balances on FTX's platform. So Alameda was basically a customer of FTX with its own account. Also said that Alameda was required to put up zero collateral on what was a $65 billion line of credit for the company, also exempting Alameda from an automatic liquidation process. It was a feature that would cover losing margin positions for customers who were trading on the platform. And finally, he said that Alameda was allowed to place orders faster than other account holders. Now, Wang said that by late 2020, that he had brought this to Sam Bankman-Fried's attention. He brought concerns about negative balances on Alameda's balance sheets after having run some queries about the company's balances, both FTX and Alameda. And he said that Bankman-Fried said, well, that's okay, but make sure that you also include the FTT, which is FTX's proprietary tokens, and some other assets in order to make the math work. Now, Wang said he again brought this problem to Bankman-Fried's attention at a point when there was a deficit, a negative balance for Alameda and therefore to FTX customers of $3 billion. And as we know, the company eventually imploded with a negative $8 billion balance, not able to repay its customers. Now, the defense is starting to put up its cross-examination of Wang. And the point that the defense attorneys are trying to make on Bankman-Fried's behalf so far is that Alameda needed the ability as a market maker to be able to run negative balances, but we'll have to hear the answer to why $65 billion lines of credit and unlimited access was the method by which these executives chose to go about running the company. Wang has already pled guilty to 4 felony accounts, so he is testifying on behalf of the prosecution, and he has his sentencing still ahead of him. Guys?
And there is still more to come on that front from others,
so much more
confidants of SBF. Thank you so much, Alexis. So as we've been talking about, we're now a week into the extraordinary criminal trial of Sam Bankman-Fried. As we've been hearing, even just today's witness testimony has been explosive. There have been plenty of takeaways so far. Here to unpack it, Nick Ackerman, former assistant U.S. attorney for the Southern District of New York and former assistant special Watergate prosecutor. Thank you so much for being here, first of all. From what we've heard thus far, how does the case by the government seem thus far against Sam Bankman-Fried?
Well, it seems so far that it's going to be an overwhelming case. You've got two other insiders that are going to testify. His former girlfriend, who was the head of Alameda. You've got another longtime associate who is also involved in running the company. So when you take 3 cooperating accomplice witnesses like this and you put them together, it's very difficult for a jury not to come back and convict. I just don't know where the defense is going to go with this. When you come up with testimony today, like creating a special back door through computer code in order to get money from FTX into Alameda that shouldn't have gone there, that they were telling the customers at FTX this wasn't happening, this was money that was being kept in their accounts, and then using it to pay off creditors in Alameda. It was basically, robbing Peter to pay Paul, and eventually it caught up with them to the tune of billions and billions of dollars. And I think that's the way the jury's going to look at it.
Nick, as I understand, the prosecutor's story is simple and powerful and direct. He stole the money, basically. The defense's story, as I understand it, seems to be, yes, there were losses here, but this is really a story about poor risk controls at a startup. What do you make of that defense argument, that defense strategy? Does it seem like a potentially strong one to you?
Seems to me to be pretty weak, particularly when you've got 3 high-level executives at the company who have already pled guilty to the same crimes that Bankman-Fried is charged with, and that this was very purposeful. It wasn't like he was in over his head. They knew exactly what they were doing. They took the money to prop up Alameda. They used it to buy personal items, to spend on lavish apartments. This was done over a period of time. It wasn't a mistake. I think, when you've got 3 cooperating witnesses like this who have pled guilty, you probably have lots of documents that back up what they're testifying to. And it sounds like they've got other witnesses along the side who are going to come in and back up these 3 cooperating witnesses. I would say this is turning into a guilty plea in slow motion, basically.
Nick, you've seen a lot of fraud cases in your career. Is there anything about this one that stands out to you? Is it the crypto connection? Is it just the seemingly a lot of frauds seem to happen sort of in plain sight, if you will. Kind of what stands out to you?
Well, I think what really stands out here is the amount of money. We're talking billions and billions of dollars. It's not really so much about cryptocurrency. This is in many ways a very traditional type of fraud where money is hidden. Basically, they lie to investors. It's simple. It's very simple. It's all about lying and stealing. And it's like any other fraud case that I've seen or been involved in. But this just involves so much money over such a long period of time and had such an impact on the cryptocurrency market that I think that's why this is extremely significant, not to mention the fact that the people that were running this thing were extremely young.
And Nick, let's say you were Sam Bankman-Fried's lawyer. I'm going to give you that job now, Nick. You're his attorney. What would you have advised him to do, Nick? Would you have told Sam Bankman-Fried to plead guilty?
Absolutely, to make the best possible deal he can. Because what's going to happen here is he's going to be convicted, and then he's at the mercy of the federal sentencing guidelines. Judge Kaplan, who is an extremely good judge, is going to play this right by the book, and he's going to wind up with much more time than if he had just come forward and pled guilty. When he saw his top three people come in and plead guilty and agree to cooperate, that should have been the end of it right there. At that point, he should have had enough sense to throw in the towel, take a plea, and get as good a deal as he possibly could to get credit for going in and admitting his crimes and showing some kind of remorse.
All right, well, this trial continues, and we will be watching. Nick Ackerman, thank you so much for stopping by today, Nick.
Thank you.
And coming up, banks are gearing up to report third quarter results later this month, and the CEOs are feeling the pressure. We're going to tell you why next. Banks are gearing up to report their third quarter results later this month. The sector is feeling the heat as it faces the likelihood of higher for longer rates and keeping an eye out for a potential recession. But some of the biggest banks are dealing with problems of a different sort, namely whether they can change. Here to break it down for us is Yahoo Finance's own David Hollerith. David.
Josh, so a couple of the country's largest banks are somewhere in the process of attempting these really big corporate shifts. And that's being led by their CEOs. Now, along with the possibility of higher interest rates for a longer period of time, this just adds an extra layer of complexity they've got to deal with when they do earnings. So Jane Fraser is attempting to eliminate middle managers at Citigroup, the country's third largest banks. And this is sort of seen as an effort to revive the bank's stock price, which has lagged peers. And Goldman Sachs CEO David Solomon is trying to trim up the bank's operations as it pulls out of consumer lending and focuses more on its core business of deal making. And CEO Charles Scharf, who is trying to pull Wells Fargo back into a system of compliance and risk controls that regulators approve by, but its legal troubles kind of keep resurfacing. So on Citi, we're not expecting any tangible numbers about the layoffs, but we do want some kind of update. This huge reorganization, as she's described it, is still a bit murky. On Goldman Sachs, Solomon is lucky in that we have seen a bit of a resurgence in the IPO market, but he's been the first to admit that the M&A market is going to take until next year to sort of reach normal levels again. He's also mentioned that there are some commercial real estate impairments that Goldman is going to probably take this quarter. And then finally, on Wells Fargo, it's still paying fines for consumer and investor violations. And the big thing here is in 2016, they had a fake accounts scandal that's kind of still been resurfacing. They've spent about $13 billion paying fines to regulators since then. And about 235 million of that has come in August. And we're expecting Scharf to touch on that and obviously some kind of progress to getting regulators' approval. The bank is not allowed to grow, and that's according to the Fed, which was instated in 2018. This rule, they cannot expand at all.
All right, David, thank you so much. Dave Hollerith, appreciate you running us through what to expect on the management front for many of these banks. Well, beer is the big winner from Constellation Brands' second quarter results. The owner of the Modelo and Corona brands raised its guidance for fiscal 2024 with its beer portfolio posting 12% sales growth. Yahoo Finance's Brian Sozzi spoke with Constellation Brands CEO Bill Newlands about the drivers behind the recent sales boom.
First one is Modelo, as you pointed out. Modelo is now the #1 beer in the country by dollars, and it's also the share gaining leader. We were up 9% with that particular brand. Our Chelada business, which is on screen for your viewers at this point, was also very strong. We're up 40% in the Chelada business. And we've had very good success with some of our new products. Oro, which is a light beer from Modelo, and Corona non-alcoholic, were also very strong. And of course, we can't forget Pacifico. Pacifico was up 15%. In the quarter and is now the #2 selling beer in Los Angeles. I mean, think about that. So to Modelo, of course, but very strong quarter for the beer business.
Oh, I've followed your story for some time, Bill, and I remember you telling me years ago, Modelo is going to be strong. You just got to believe in it. I wasn't really a big believer, but you've proven me and a lot of other folks out there wrong. But what do you say to those people that your beer, Modelo, is now #1 in this country because of all the troubles happening over there at Bud Light?
We expected that we would take over as #1 in a couple of years. We just didn't think it would happen quite as quickly as it did. Obviously, we've got a very strong situation with the Hispanic consumer, and we get tailwind because of the growth of that consumer in the U.S. But it's also very much broadening its base as well. Today, it's 55% Hispanic, 45% non-Hispanic. So we're seeing a real increase in broad-based awareness and of that brand. And we just see it having a long runway for a long time to come.
If the consumer next year, Bill, gets over their squabbles with that Bud Light brand. Do you anticipate, basically what I'm trying to figure out is how resilient is your growth in Modelo, do you think?
Our growth has been going on, Brian, as you know, for about 30 years, which makes it not anything that is unique to a point in time. This has been developing for a long, long time. And it's growing now, not only in the original base, which was on the West Coast of the U.S., but in many markets across the U.S., like Florida and the Carolinas and Illinois and Texas. So we think this has a long, long runway. And we've added some things into the franchise, as I mentioned a moment ago, with things like Oro. So lots and lots of upside for the Modelo brand.
Is that Pacifico brand, and you told me about a year ago, too, to watch out for this brand, so I've been watching it very closely. Is that the next Modelo for Constellation Brands?
We think it could be. It's done very similar to what Modelo had done, which was it created a very strong franchise on the West Coast. I mentioned to you a moment ago, it's now the #2 beer in LA behind Modelo. So it's got a tremendous franchise, but you're starting to see very strong shoots of growth in other markets around the country. And it tends to be a somewhat younger consumer. So we're very enthusiastic about the future of Pacifico, and we do think that it could easily be the third big leg on the stool with Corona and Modelo.
Another tough quarter in the wine business, and you guys have really tried to turn things around. I suspect when you have your investor day in a couple weeks, investors will hear more from you on that front. At what point do you just say, maybe we don't want to be in some of these wines, and maybe we don't want to continue to reinvent a brand like Svedka Vodka?
We've spent a lot of time over the last few years reinventing that business. Just 3 years ago, 2/3 of the business was in the low end or mainstream portion of the business. Today, it's 1/3, and the higher end of the business is performing very well. The mainstream, however, is not. It's almost the tale of two cities. But we're seeing excellent growth at the top end with brands like Meiomi and Kim Crawford and High West, and The Prisoner. We're seeing a lot of opportunity there, which we think will really turn around in the back half of the year as we see many of these brands accelerate.
Of course, Bill, today's jobs day in America, really blowout jobs report, I think shocked a lot of people on the street. How aggressively are you hiring in your business?
We're probably fairly stable within our business. We're obviously growing our production footprint in Mexico because we're adding a third brewery. So you're seeing quite a bit of increase in that particular area. But I'll go back to your comment about the jobs report. That speaks very well for us, for the beer business. There's good employment is very good for the beer business. And obviously, as the share leader and the growth leader in the category, we're there to absorb a significant portion of that added spending power that the consumer has.
But still, I think you would agree, Bill, not everybody is benefiting in this economy. Not everybody's doing great. We just had the return of student loans here on October 1st. And a lot of the research I've been ingesting suggests consumers are pulling back. They're trading down to private label. How concerned are you that happens in your business and you see that trade down effect?
One of the things that we're seeing is that the consumer is going to the store more often, but spending a little less while they're there. The good news for a company like ours is we have such strong brand support and brand recognition that we are still getting the consumer purchasing power. They're just doing a little differently, and they're more careful about what they spend on any particular occasion. But it really hasn't significantly impacted. As you saw, our growth profile in this quarter in the beer business was up almost 8% on depletes. That's a very strong takeaway, and the takeaway in Circana data was even stronger, up double digits. So you can easily see that our business continues to perform extraordinarily well, and that really speaks to the strength and the brand loyalty that we have within our brands.
Bill, lastly, I was going to bed last night, I guess somewhere around midnight. I'm like, let me just check the Yahoo Finance homepage one more. I want to see what people are searching. I'm curious on what tickers they're watching. Some of the most trafficked and popular tickers on our page are Coca-Cola and PepsiCo. And there's a lot of concern in this country that the beverage makers, snacks makers, they feel an impact from these weight loss drugs that are proliferating throughout this country, that there is reduced consumption. Do you fear these weight loss drugs impacting demand for Modelo, Corona, or other products you sell?
Interestingly, Brian, we've never had it. We do a lot of consumer research. We've never had a consumer bring that topic up with us. And some of it is the whole social aspect of alcohol consumption. A lot of it is engaging with other people. There's a social element to it. And while there is a subsegment of that population that's interested in betterment, as we talked earlier, that's part of the reason why Corona non-alcoholic's done so well. The majority of people are not as concerned when they bring an alcoholic beverage into their mix of what they're consuming as they would in some other areas. We think certainly for our sector, it's overblown.
Well, that was Constellation Brand CEO Bill Newlands talking about the hot topic of the day. That was interesting. Coming up, we're going around the horn with some of the top stories of the day, including Taylor Swift's blockbuster documentary. That's next.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal, joined by Brooke DePalma, Josh Schaefer. And guys, I want to kick us off with a stock that we talk about quite often, and that is Apple, the tech giant that is Apple. They reportedly want to earn the broadcast rights for Formula One, otherwise known as F1. According to Business F1 magazine, the reported bid is worth an estimated $2 billion a year for 7 years. Now, that would be double what F1 currently earns from its existing media deals on an annual basis. And F1 has multiple broadcast partners depending on where it is broadcasted in the world. So it's ESPN in the US, Sky Sports in the UK, and Fox Sports in Australia and Mexico. But this, of course, comes on the heels of a lot of streaming companies really racing for sports content, no pun intended, to really create that stickiness on the platform. Apple also reportedly wants to get into college basketball?
College football.
College football.
Apple reportedly wants to get into every sport ever,
Right.
according to everyone else.
They have MLS. Right,
But
the Messi effect.
That's the biggest thing I'm wondering out of this, is when is Apple going to actually get into most sports that people watch? No offense to the MLS, but that is not exactly one of the bigger leagues in the U.S.
Right, I think Messi really brought in a lot of folks there.
Messi helped them out and sort of made it a moment for Apple TV. But realistically, like, I wouldn't count the MLS as a big jump into sports. We've been told for several years now, Apple really wants to get into sports. But what happened in the NFL deal? Are you actually going to get into F1? Are you going to get into this NBA media rights deal when it comes up? At some point, Apple can get into these things if they want to. We talk about it all the time. They have the cash. Mm-hmm. Do they actually want to get in as bad as people are saying? I'm starting to question it until they actually do get in. Because right now, having Major League Soccer to me is not some big sports push.
Well, I've been talking to a few analysts here, and they said that Apple is more quality over quantity, and they really want to get into these sports that have the opportunity to grow. So if you take a look at F1, it has a very young audience that's obviously attractive for Apple. And, you know, it has the ability to grow in the United States. Already we have, from Drive to Survive, from Netflix, this interest around F1 becoming more and more apparent. And there's more room to run down the line. So I do think in that respect, and you could argue the MLS is the same way. Yes, it's crazy popular overseas. It probably is, it doesn't have the same effect in the US. It's starting to. I think Lionel Messi was a good step in that direction. So to just play devil's advocate, to your point, that might be what they want to try and get.
Yeah, and I'm curious too, how much of content is Apple looking for here? I mean, we constantly are covering the writer's strike and the actor's strike. I know that you're on top of it, but it's a question of, you know, are they looking to bring in different opportunities, bring in new audiences, and how much content are they, you know, trying to get on since they don't have that backfill of shows that they once had maybe a few years ago? And when you think about, you know, what we've seen in the past few months with MLS and things like that, I just don't know if it played out exactly how they would have predicted if it wasn't for Lionel Messi. And I think that it's, you know, as I was saying before, there's Max Verstappen, there's Sergio Perez on F1. They have a large fan base, but does every single one of these players have a large enough fan base to bring a major audience to Apple that would really pay this off?
And what happens to Drive to Survive, right? We didn't even talk about that. We're talking about F1. We talked a lot about that Netflix effect.
Yeah.
You would assume if Apple is going to get involved, they would want that popular documentary to now be on their streaming
platform.
Of course.
Which would be presumably great for Apple.
And that has been Netflix's game plan. Right now, they're not doing the live sports, but they're leaning into the documentary side of it.
Right.
Now, if I were Apple, I would partner with Taylor Swift. You partner with Taylor Swift.
She's everywhere.
You partner with Taylor Swift and your stock goes up. If you take a look at AMC shares today, I think they were closed up about 10%. This on news that Taylor Swift's Eras Tour, the concert that is being shown in movie theaters, now over $100 million in ticket sales. There you go. AMC shares closing up 12% today on that news. So quite a big pop for the movie stock on that news. The thing I'm wondering here about this is we know Taylor Swift, she'll move tickets, right? People are going to go and are going to see it and they're going to love it because it is Taylor Swift. I am curious about concerts in movie theaters though, and I just don't know if we're gonna get the answer from this experience because it seems like every Swifty's gonna go, they're gonna say it's awesome. It probably will be awesome, she's great. But what does it tell me about the prospect of showing concerts in theaters? I don't know if we get that answer.
Well, it's not just Taylor Swift, right?
Yeah.
Beyonce's
but everyone loves Beyonce. They're all like too awesome.
Yeah, and I have to say that concerts in movie theaters have been going on forever. I mean, I was a fan of Glee, and I once in 2012 saw the Glee. I went to the Glee concert, and then I had to see the movie.
I didn't see the movie, but I went to the concert.
Right? So I literally went to both. I feel like this is something where you get a re-experience of an amazing night that you had at the Taylor Swift concert. You want to recreate that with your friends. You want to once again trade friendship bracelets, and I feel like this is momentum to this concert yet again is building. Now I don't know when she goes on her world tour, but then like could we see another concert after that?
Right? November, because the people have been talking about that with the Travis Kelce relationship. Because Taylor Swift presumably won't be able to go to the games anymore. That's something I've circled on my calendar, Brooke.
Right.
She'll be there though if they make it to the Super Bowl, their playoffs.
I bet.
Well, she has to.
All right. Well, no confirmation that they're actually dating.
Right. Yeah.
Rumored.
But I certainly think that when you think about what exactly what customers, fans are going to watch, I mean, we were just chatting about this before. We don't even know exactly what the movie is. Is it one concert? Is it many concerts into one? Beyonce, we have a direct line. It sounds like a real sort of documentary style, her, Blue Ivy, on tour. We're going to get an inside look at the tour. Are Taylor Swift fans just going to see the movie? I guess we'll have to wait and see.
Well, I don't think it really matters at the end of the day. You know those fans are going to show up. And I think in the context of the writer's strike and how these movie theaters, they don't have a lot of content right now. We've seen some of the most popular films of the fall be pushed into 2024. This helps to fill the gap. And it's a great thing for movie theaters, which is why we're seeing all the stocks up today.
Yeah. I'm signing on. I'm a Swiftie. I want my stock to go up. I want my personal stock to go up.
I think I need to go see it. We should all see it on opening night.
I definitely want to see it.
All right, we'll go.
We'll get tickets. It might be hard in the first weekend, but we'll eventually grab tickets. But today I'm taking a closer look at actually Crocs. So quick pivot here, but they're out with a cowboy boot, country girl maybe style. I mean, this Croc boot, you have to see it. It has metallic charms, a spur on the back, and it also has black, it has white Crocs logo on it. I mean, they're certainly making a big bet here, but this has been years coming for Crocs to introduce this cowboy boot style. And I mean, if you look at sort of the run-up of Crocs stock recently, in the past 5 years, I mean, they're up, I think, nearly 270%, if I have that right, but they're definitely up well over 100%. Yep, there you see it. But year to date down, but in longer term, up there, right there,
pandemic,
up 340% as consumers really make this shift to a more leisure lifestyle. I know Allie and I have heels, you have sneakers, but consumers really changing their habits about how much they're willing to put up with uncomfy shoes, and they want more comfort.
We were just talking about Taylor Swift and sort of how she can attach her name to anything, and there's like the large group of Swifties that follow, right?
Yeah, right.
Crocs has such an impressive, loyal following.
Yeah.
They come out with these they feel random releases, right? Like Hidden Valley Ranch and Crocs team up, and they look kind of goofy online. Right? Yeah. And then all of a sudden, people are buying them. Like, they are great at the collaboration game and getting people to collect more Crocs. Those cowboy Crocs are awesome, though. I mean, tell me those aren't going.
Would you wear them, though?
I see those on Broadway in Nashville. Broadway in Nashville, you're hitting the bars. You want to go
also,
cowboy boots.
Some of those music
or you
festivals,
want to be able to move.
Yeah, some of those music festivals I think could be really comfy. And look, Crocs, they exploded during the pandemic.
Right.
People wanted to wear comfier clothes. The Crocs CEO was on CNN basically saying that the business is still booming because people don't want to dress smartly anymore. They just want to keep it chill and casual. And I guess in the age of hybrid work, remote work, if you can keep it comfy, you want to keep it comfy. And also, you have your celebrities that have attached themselves. You mentioned Post Malone, Justin Bieber.
Right.
And now you got to get a country singer in those. You got to get a country singer in those Crocs cowboy boots.
And not to, quote Taylor Swift, but in an era where celebrities, whatever they do, people seem to follow.
Right.
That's a good thing for Crocs.
Who's next? Who will Croc team up with next?
I know.
That's the end of our era today, though, guys. We'll have more Yahoo Finance Live on the other side. We're going to break down what's coming up next week.
It is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Signs of progress in the United Auto Workers strike. The union securing a big victory from General Motors. UAW President Sean Fain announcing that GM will treat workers at EV battery plants just like workers in engine and transmission plants. As a result, no new factories being added to the strikes this week. Some good news for drivers. If you're in the market for an electric vehicle, starting next year, you'll be able to get the tax credit off the sticker price while at the dealership instead of waiting to receive your tax returns. These tax breaks are part of the Inflation Reduction Act, and under the Treasury Department's guidance, buyers can receive $7,500 off for a new EV or $4,000 off a used one. And Amazon officially joining the space race.
5, 4, 3, 2, 1. We have ignition and liftoff of the United Launch Alliance Atlas V rocket.
The company launching its first satellites, putting Amazon in direct competition with Elon Musk's Starlink and SpaceX.
And here is what to watch next week. And it's going to be a busy one. The big ticket item on the economic calendar will be Wednesday's CPI data. Economists expect inflation to rise by 0.3% in September from August, which will be a slower rate of growth. Core CPI, which excludes volatile gas and food prices, also expected to rise by 0.3%. And earnings season gets underway. PepsiCo and Delta will be reporting ahead of the open and Tuesday, and things heat up Friday when JP Morgan Chase, Citigroup, and Wells Fargo all report. And in Washington, the race for the next House Speaker will heat up. Congressman Jim Jordan and Steve Scalise are the two top candidates, and former President Donald Trump is expected to head to Capitol Hill, and he's already endorsed Jim Jordan. In corporate news, Microsoft reportedly looking to close its deal with Activision next week. The Verge is reporting the $69 billion deal for Call of Duty publisher could close October 13th if it gets approval from Britain's antitrust regulator.
So busy week next week. Rest up for you, Josh, and for all of you out there. That does it for today's Yahoo Finance Live. We'll be back here Monday, 3 p.m. to bring you all that news that's coming next week. Have a great weekend.